Hello everyone, thanks for checking out my video. All three US major indexes ended last week in the green, with the latest rally driven by an improvement in market sentiment after investors got more certainty around President Trump's tariffs plans. What amazed me was that investors have struck off the hotter than expected inflation data as we are just a whisker away from another new record high. It seems like everything is about Trump right now, all other stuff is just noise. So, after making past an eventful week largely unshaken, can we expect a new record high in the upcoming week? Or are there underlying issues that investors should be worried about? Let's discuss them in this video. As always, watch on to find out more. Alright, S&P 500 closed out last week slightly short of record high as big tech led the week's rally with Nvidia, Apple and Meta recorded decent gains over the 5-day period. Apple was the outperformer in the Magnificent 7 as it rose more than 7% last week. Nvidia gained close to 7% and Meta was up more than 3%, hitting a few record highs throughout the week. All these gains happened as investors powered through hot inflation data, postponement of reciprocal tariffs, and weak retail sales. Very quickly, let's break down these three items. First up, inflation. The annual headline CPI inflation rate unexpectedly rose in January to 3%, which is higher than the estimate of 2.9%. In addition, core CPI inflation increased by 3.3%, also higher than the forecast of 3.1%. Okay, on top of the CPI data, PPI also came in hotter than expected. January PPI inflation unexpectedly rose to 3.5% above the expectations of 3.2%, while the core PPI inflation was at 3.6%, also above expectations of 3.3%. All these reports have dashed the hopes for another Federal Reserve interest rate cut anytime soon. Some economists are even saying that the Fed's rate cut cycle could be over and there could be a rate hike instead, especially if Trump ends up imposing tariffs that last a long period of time. This then brings me to the next point, tariffs. So last Thursday, President Trump signed a plan for reciprocal tariffs but delayed the implementation as his team launches negotiations with nations that could be impacted. A delayed implementation will definitely lower the short-term impacts, especially for the stock market, which was why major stocks rose last Thursday as investors received the news that these tariffs wouldn't go into effect immediately. And finally, we had the retail sales data which came out last Friday. Basically, retail sales clocked their biggest monthly drop in a year, down 0.9% in January, very much below the expectation of 0.2%. However, the market wasn't too alarmed as many believed that the decline was due to the effect of wildfires and winter storms, which kept people at home as well as consumers taking a break after spending strongly during year-end holidays. Alright, looking at the week ahead, the stock market will be closed on Monday for President's Day holiday. On Tuesday, when the market reopens, Fed official Mary Daly will be speaking at a conference for community banks. Some investors might be keen to hear what she has to say as her public engagements are often used to drop subtle clues regarding the Fed's future monetary policy. On the very same day, China tech giant Baidu will be reporting their quarterly earnings. Again, some investors might be interested given the recent tariffs on China, the rally in the China market, and all the AI talks involving the companies from China. Then on Wednesday, 19 February, we will get the FOMC meeting minutes, which investors will look to assess and confirm the Federal Reserve's latest stance on easing monetary policy this year. On Thursday, 20th February, Walmart earnings should give investors fresh insight into the health of US consumers, who are now facing rising inflation again, and also uncertainties over whether Trump's tariffs will drive up prices even further. Okay, but all in all, I don't think all these events that I have just mentioned will move the market by too much. And unless we have some unforeseen circumstances happening that could tank the market, I think there is a decent probability we could see a new all-time high this week. Which brings me to the next segment, technical analysis. Okay, let's have a look at SPY, which represents the broader market. Things are looking decent at the moment, especially when a series of hot inflation reports could not bring down the market. Technical wise, SPY did another retrace and rebound last week, something that we saw in the previous 2 weeks. In the process, SPY bounced off the 50 moving average. In addition, the MACD also did an U-turn or reversal. All these are bullish moves. Given that we don't have massive events this week, I am actually expecting the bullish momentum to bring SPY above 611 to create a new all-time high. In fact, it may hit 612 before facing a bit of resistance from the Fibonacci extension level. Above 612, the next resistance is at 618, but like I always said, at all-time high or uncharted territory, you would never know when will market makers step in to sell off their shares. So if we hit new record highs this week, just enjoy the ride and don't try to be too clever by shorting the market. On the bearish side, it's pretty simple. Bears have to bring SPY below the 50 moving average to create a new bearish momentum. But just to note, a day or two below the 50 moving average doesn't mean anything, as we saw how SPY bounced off this moving average recently. So for me to call SPY bearish, I would need to see SPY hitting the 61.8 Fibonacci retracement level at 588, because that's where that huge gap is. All in all, as long as SPY stays above 588 and the 50 moving average, the overall sentiment and momentum are still bullish. Moving over to Apple, similar to SPY, Apple's MACD did a reversal, and we saw a few solid green candles last week. In the process, Apple reclaimed the important levels that I have previously shared, the 237 and the 50 moving average, and so obviously this is bullish. But here's something to note, as Apple rebounded and is on its way to the top, it's currently at the critical 61.8 Fibonacci retracement level at 244. The previous time when Apple hit this level, it was only during intraday and it printed a very ugly red candle. So last Friday, Apple tested this level again and closed just above it. This is definitely more positive than the previous round. But Apple isn't out of the woods yet. For Apple to be caught very bullish, it needs to continue to stay and close above this 244 level for a few more days, or even better, go above the recent intraday high of 247. When that happens, there is then a high probability for Apple to enter the 250s range again. On the other hand, in terms of the bearish thesis, once again pay special attention to the 50 moving average and that 237 level. As long as Apple stays above these two levels, we are good. But if somehow Apple loses these two levels, I do think it will likely continue to fall further towards the 220s range, which we have seen in the past 1 month. And at 220s range, watch the 200 moving average very closely. That's the last line of defense. If Apple loses it, which now sits at 222, we could see a waterfall in the share price. Okay, let's now jump over to Tesla. If you could recall, in my last video, I specifically mentioned that if 350 gets breached, I'm not kidding you, the share price might grind towards 330s or 320s range, where that mini consolidation zone is. Can you see how Tesla hit 325 last week? I hope that could earn a like button from you. Alright, I know Tesla has fallen quite a lot from its all-time high of 488 to the current price, but here is one small positive sign. Note the word one and note the word small. Just one small sign only, which means Tesla is not out of the woods yet. Let's break down the details. Okay, basically, Tesla went near the critical 61.8 Fibonacci retracement level, which sits at around 318, but did not breach it. That's positive. At that point, Tesla was very oversold on the RSI, which sets the chart up for a nice rebound, and it did. Tesla really rebounded, but here's a small problem. Okay, again, note the word small. As Tesla rebounded, it tried to reclaim the first Fibonacci retracement level at around 364, but failed to do so. Just to also highlight, this 364 level is also where the top end of this mini consolidation zone is, which makes this level even more important. Therefore, come this week, if Tesla can close above 364, I think we can say hello to 380s range again. If that's really the case, and if you could ride this 20 points upside, I think you can earn some decent profits. But please, this is not financial advice because institutions can dump Tesla shares anytime. Have some stop loss in place if you really want to trade this upside. By the way, if you could spare me just 30 seconds, if you would like to support this channel and are looking for a new brokerage account, do consider signing up a Longbridge account using my referral link. Deposit 2,000 Singapore dollars, maintain the fund for 30 days, make 3 separate buy trades, and you will get a free Nvidia share. There's also additional $18 cash coupon for you if you sign up using my link. Okay, back to business. Just to highlight, I remain cautious about this bounce in Tesla's share price because, like I said, Tesla hasn't reclaimed that 364 resistance level. On top of this, remember this zigzag pattern that I drew last week? It could still continue. Watch for 350 again as the support level. If this downtrend zigzag pattern continues, it means last week's bounce was what we called a dead cat bounce, and from there I would expect Tesla to hit 320s range again, which represents a 30 points downside from the current price. Well, a 20 points upside versus a 30 points downside. Either way, if you could catch it, you will get some nice profits. I know it's tough to predict the next movement, so watch those key resistance and support levels very closely. Finally, just to add, the 61.8 Fibonacci level at around 317-318 is very important. If it breaks, things can get very ugly for Tesla because I don't see much support below it. Alright, let's now move over to Google. Google's chart looks pretty neat to me as it completed its 100% retracement to 181, a level where it was about 2 months ago. The good thing is that it rebounded off this level and did not enter the huge gap area. But hang on, before you get too excited, I have to say Google is not out of the woods at all. For Google to potentially reverse this short-term downtrend, it needs to reclaim 2 important levels. The first level is the blue line that I drew at around 188. The second level is a double resistance level formed by the 50 moving average and the 61.8 Fibonacci level that it previously lost. The level is 191. But for us to say that Google has turned around the bearish trend, obviously it has to fill that huge gap down that was created after it reported its earnings. As for the bearish side, watch the level 181 like a hawk. I would call it a pivotal level because it has turned from a resistance level in the past into a support level. So if Google falls below it, this level will once again become an area of resistance. Below 181, I am of the view that Google will fill or if not a huge portion of that gap between 176 and 181. This is an area where I would consider stepping in again, either to pick up shares or to sell put options. Moving over to Meta. Meta looks unstoppable at the moment. Like a broken recorder, I am gonna repeat this again. At record highs, sellers tend to dry up and the share price will keep going up till God knows which level. And that's what's happening right now for Meta. So last week Meta punched above the 161.8 Fibonacci extension level. That's super bullish. The next meaningful resistance is at around 759, which you can't see on the screen. This means Meta still has room to go for the upside. But before you all get too excited, back to what I have just said, you will never know when will institutions start taking profits. So for long-term investors like me, I will just enjoy this ride up and not add any shares at the moment. Anyway, if I were to choose a side, I am leaning towards the bearish camp this week. But this doesn't mean the share price will tank, it just means there could be a small retracement or sideways movement. Got to be honest with you, I don't have a crystal ball, but it's all about probability. I do think the probability of the share price retracing is higher than last week. Reason being the 6-day RSI is at a very overbought level right now. The reading is 97.4. I actually had to search high and low to see when was the last time this 6-day RSI was at or above this level. Guess what? It never happened. This means this is an unprecedented level. The only time it went close was back in 2013, which was 12 years ago. During that time, the 6-day RSI hit 95.7. And to add on to this amazing feat, Meta has risen for 20 consecutive days, and this marks the longest winning streak in history for any Magnificent 7 stocks, and one of the greatest runs in the history. So with all this in place, I am of the view that the probability of a retracement and sideways movement is higher than before. Anyway, if market makers decide to take profits, don't be surprised if Meta falls below 700. Okay, let's now have a look at Microsoft's chart. Among the few stocks that I cover, Microsoft seems to be the weakest right now. It has actually retraced 100% from the high of 456 to 404. But here's a saving grace, it bounced off the 404 support level after briefly touching it. Come this week, don't be surprised if Microsoft retests this 404 level again. Whether it holds or not is a big question mark. But let's say it doesn't hold, I would then expect the psychological level of 400 to get breached as well. The next meaningful support is that green line that I drew at around 396, but you might want to stretch it a little bit more to the 123.6 Fibonacci retracement level at 392. If this area breaks, I think we can say hello to 385. If we ever come to this 385 level, I would be very excited to add more shares or sell a put option. Not financial advice, of course. Alright, on the other hand, if we want to see Microsoft stopping its rot, wow, it's a long way to go, man. I think one key level that it needs to reclaim would be the 200 moving average at 424. That's also where the 61.8 Fibonacci level sits. But that's not enough in my opinion. We need to see a further push up towards the 50 moving average. If somehow we can reclaim both the 200 and 50 moving averages, then I think Microsoft has a high probability to complete the gap fill. Anyway, the range of that gap is 422 to 440. It's a long way to go, but never say never. And for those who have wanted to pick up Microsoft shares, have you done so recently? If not, what is your entry point? Alright, moving over to the hottest AI stock, Nvidia. Wow, Nvidia is on this little monster run with 10 straight green candlesticks in a row. I'm quite glad that I sold 3 put options when it plunged during the DeepSeek saga. Anyway, in my previous video, I shared that if the MACD had a bullish cross, we could see 135 at least. Well, that happened last week. In fact, Nvidia went even higher to 139. Okay, but at the current price, it's facing a bit of resistance posted by the critical 61.8 Fibonacci level. Okay, what I'm gonna share next is just my personal view, alright? So, my take is, if we can continue to stay above this 61.8 Fibonacci level for another 2 more days or so, I believe the stock could fly towards the high 140s range. At that point, it depends on where the RSI is and also a few other indicators. If there's room to go for the indicators, then we could see a new record high, which means above 153. So be sure to subscribe to my channel for more updates on the indicators and Nvidia's share price. Okay, on the other hand, if Nvidia starts falling back below the 61.8 Fibonacci level, which is 138, that means the bullish momentum is taking a small break. But don't worry, it's not bearish yet. I mean, it could retrace and then rebound, right? In fact, that's even better. A retracement can help to cool off some of the indicators. But here's the but. If the share price retraces and starts falling below the 200 moving average, then I would say Nvidia is turning bearish again. When that happens, will I panic? Nope, I won't. I will be excited. That's when I will consider selling put options again. Okay, moving over to options trading should be a quick one, just one trade to update this week, and that is this new cash secured put on Tesla, which was sold last Friday, 14th February. For selling this option, I received $225 as premium, which is around 300 Singapore dollars, and that has helped to offset my Valentine's Day dinner. Okay, I'm kidding. Anyway, this is a tricky and risky trade, hear me out. Basically, Tesla was very oversold on 11th February. The 14-day RSI has reached a level not seen since April 2024. To add on, the last few times when Tesla's RSI hit this level, we saw a little bounce in the share price. So one day after the RSI hit that oversold level on 12th February Wednesday, buyers really stepped in and pushed the price up. I wanted to sell a put option on that day but couldn't find a suitable entry point. Furthermore, I recalled I was busy on that day and couldn't watch the market closely. Then on 13th February Thursday, the bullish momentum continued. I quickly placed a sell order for a put option with a strike price of 265 and asked for a premium of 290, but the order didn't get filled. By the end of the day, we already had 2 green candles to confirm this oversold RSI technical rebound. So finally on Friday 14th February late in the night in Singapore's time, I was contemplating if I should chase the trade per se. Remember, we always say don't chase the price and don't FOMO. Well, I assessed the risk and I decided to go ahead and sell that put option. But to manage my risk, I decided to stick to the strike price of 265, a price that I am okay to accept assignment for 100 shares of Tesla. The downside to this trade is that the premium is not as lucrative as I had sold a day or two earlier. Therefore, in conclusion, depends on how you say it, one can say that I'm trying to chase this trade, while on the other hand, one can also see it as I didn't chase the high premium and I stuck to my desired strike price of 265. What do you think? Meanwhile, the trade is up about 20% now. Let's see how it pans out eventually. Okay, as always, sharing some thoughts of the current market situation. As mentioned at the opening of this video, it's all about Trump right now. Almost all other stuff is just noise. Right now, investors are more focused on what is Trump going to do next and how will his tariff plans affect the global economy. This is why even the latest hotter than expected inflation reports and weak retail sales data could not bring the market down last week. Although investors were relieved after last Thursday's tariff announcements, we need to remind ourselves that Trump remains a wildcard. Any aggressive moves from him could ultimately lead to retaliation from other countries, which could in turn weigh on stocks. Just a gentle reminder, we have seen that in the past few weeks where the stock market sold off when Trump came up with surprise tariff announcements. Okay, looking at things in the longer term, I must say and highlight that based on the latest reports, inflation is clearly above the trend, and mind you, Trump's tariffs have not really kicked in or ramped up yet. Honestly, whether Trump is going to implement the tariffs immediately or not, it will definitely still have an effect on inflation if it materialized. To put it simply, it could lead to a further increase in inflation. Needless to say, high inflation means the Fed cannot cut interest rates yet, and that could pressure the stock market. But with all that being said, it's still nice to see the US stock market has taken Trump's tariff threats in stride. I think the current belief in the market is that Trump is using all these tariffs as a tool for negotiation, and he may ultimately avoid triggering a global trade war in order to prevent damage to the US stock market and economy. I mean, he's a businessman after all. Okay, so the long and short of it is that whether we all like it or not, we have to follow Trump and his related tariff plans very closely. On one end, he can be a businessman who supports the US economy. On the other, he can be a wildcard that triggers sudden sell-offs in the stock market. Well, as always, be sure to subscribe to my channel as I continue to provide weekly updates on the US stock market. Don't forget to like this video if you found my content useful. Thanks a lot.